Hello, everybody. Welcome to a very special episode of the Loan Officer Wealth Podcast. We have Barry Habib with us here today. Hey, Barry.
Chris, it's always great to be with you. I have to tell you, I think the world of what you do and your knowledge base and what the exciting things you're doing with AI to just take our industry into the future. So it is a privilege to be here with you.
Awesome. Well, thank you so much. I don't think you need an introduction, but author of Money in the Streets. And Barry, I've had the pleasure of watching you many times on stage, and I have never not seen you get a standing ovation. So I think that speaks to the quality of the person, but also the content.
I'm humbled and always incredibly grateful and appreciative. I know that people have a lot of things that they can be doing with their time, and the fact that they decide to choose putting off some of those things and spending time with me is something that I really take to heart. I completely cherish and honor that. And I'm very, very driven, Chris, to try to always deliver things that create value for them, but in a way that is not easily available through other sources or that isn't readily accessible. So I push myself pretty darn hard, and Chris, you've seen me speak enough to know that the presentation always changes. It always takes turns. There's some things that kind of evolve. It's more of an evolution rather than wholesale changes, but it is always very different every time I do one because I push myself. I have a kind of a routine where there's a lot of preparation that goes into it prior to it. But then right after each presentation, whether it be a Zoom or whether it be a live presentation, there is a reflection point immediately afterwards, and there's adjustments that's made. So it's a constant push and strive to do better every single time. And it really started when I was, I don't know when it actually started, but it carried through from my origination days. Chris, I originated a reasonable amount of business in my time, back in the dark ages before electricity,
Hardly.
so but I was a good originator, me and one assistant, we did a little over $2 billion in production. So and there was lower loan size averages back then too. But every single client consultation I had, there was a reflection afterwards.
Mm.
What worked, what didn't work. I used to record my conversations that I would have on phone, and I'd listen to them. And quite honestly, sometimes I'd cringe. Like, I can't believe that came out of my mouth. I can't believe I did that. And uh, it really helped me get better faster.
Mm.
So I think that whatever you do, whether it's in the mortgage business or anything, the constant push to get better is really critical. And not only does it pay off because you get better faster, because it pays rewards, because you will reap financial rewards from it, but Chris, it really comes down to something that, for very selfish reasons, we all want to be happy, right? We all
Yep.
want to be happy, and happiness is fleeting. It's difficult to obtain. So I think we need to have like goals that are financial, very important. Don't let the current uh, social environment poo-poo the fact that financial gain is bad. It is a very important and good thing,
100%.
especially because you could do good things with it. But
Hmm.
you should also have achievement goals. But I think fulfillment goals are the most important thing, and that comes from helping others. Now, you
Mm.
can't give what you don't have. So if you constantly are striving to get better, it allows you to give to others. But happiness, in a word, the easiest way to achieve happiness is to have progress, moving towards something. It's why we always have to have goals. And when you hit a goal, you need to have another one, because once you hit that goal, the joy of hitting that goal, it doesn't last very long.
Yeah.
It's very temporary. So you constantly have to have goals. And then the journey towards the goal, that's what gives you the happiness. It's the
Mm.
progress. Look, I've been really trying to lose some weight, and I
Really?
have a goal. Yeah, yeah. I've been doing the intermittent fasting, and so I've been really on this kick. So I've been somewhat successful. I had a goal to drop about 25 pounds. So I've gotten down to about 15, 18 pounds. I'm not at my goal, but I'm so much happier
Yeah.
that I'm so making even the first like 3 pounds. I'm like, okay, I'm feeling happier. So I think progress gives you a better way to realize happiness.
Yeah. Oh, absolutely. And intention too. Just having the control over your life that it's like I'm not just going to wake up and, get knocked around all day and then go to bed again and do it all over the next day. It's I'm going to wake up, I'm going to go get what was set aside for me ahead of time. So, Barry, that's so impactful. Thank you. And I know, so we have membership, the AI Inner Circle, and I made a little Facebook post inside the group and I said, hey, I'm got the pleasure of having Barry on the show. And we had a couple of members come up with some questions.
Oh,
And everybody sees you as the oracle, maybe, in the mortgage industry. And obviously, many of the questions were, what's going to happen with rates? What's happening in the market right now? What are your predictions? What do you say?
so listen, and I'm so grateful and appreciative for those kind words, but nobody gets it right all the time. Certainly not me. I mean, I've made mistakes. I don't want to make mistakes. You don't want to get calls wrong. You do a lot of work to try and get them right, but it doesn't always work out. I mean, I've been very blessed and I'm very grateful that there have been a lot of calls that have been extremely good over the, I don't know, gosh, I've been around for a long time, so over decades. And in order to do that, you have to put your neck out on the line, which, okay, I
Mm-hmm.
do that a lot, but sometimes that means you're going to get it wrong. So last year, um, we made three really important calls at the beginning of 2023. And one call was on the housing market, which said 6.8% appreciation. This was a very bold call because, Chris, as you know, so many people said with affordability, with this price is going to drop 20%. I debated Ivy Zellman, I debated Grant Cardone. Everybody thought the housing market was going to crash. Really smart people, David Rosenberg, brilliant people. But we said 6.8%, and it looks like we're going to be, darn it, I think it's going to be 6.8% when it comes. We only have the numbers through November, and it's 6.4% through November. So put it this way, we're going to be really, really close on that one. So I'd call that, we're nailing it. But then we made a call on interest rates. And I put my neck out on the line. I said, look, I think in 2023, starting in May, rates are going to come down. And I think that we're going to see rates in the fives. Okay. Obviously, I got that way off. But again, I don't want to be wrong on it, but I own it. I was wrong. But here was the logic behind it. It was based upon where we thought inflation would go. And look at the last 50 years, interest rates follow inflation.
Yep.
We thought that's a pretty good baseline, right? So we couldn't forecast, just on mortgage rates. We had to say, what are we basing it on? We based it on our inflation call. So, man, Chris, we took apart what we thought all these different components would be. And I spent so much time and I made a crazy call. In January, when inflation on CPI was 7%, I said, I think it'll hit 3% in June. People said, Barry, you're freaking nuts. Chris, look at what the CPI was in June. It hit exactly 3%. But based upon that, I said mortgage rates would drop.
Mm-hmm.
Not only did mortgage rates not drop, but they went the other way. There was a reason for that. The banking crisis, that should have been a warning signal for me. I thought we could get over that. But then it was the debt ceiling removal and $2 trillion of paper coming on the market. So those $2 trillion of paper had to be absorbed. We had Fitch downgrade our credit. And listen, that caused rates to rise. But now we've had that debt absorbed. And, maybe it started happening, not in the summer, but in the late fall or mid fall, when we started to see rates really start to make a move lower, not towards the 5% target, but at least from 8% into the mid to upper sixes. So we did start to see that a few months later once that debt deal got. So I bring that up because what we understand is that, first of all, predictions, don't bet the ranch on them. Okay, number one, they're based on educated forecasts and a lot of work, but things can come out of the blue, like what we saw with the debt ceiling deal, like what we saw in the banking crisis. So things can come out of the blue and really disrupt it. But what we also want to look at is we want to look at what caused rates to rise a lot. And it was supply of paper. Our government runs an enormous amount of debt. So we currently are spending $2 trillion more than what we take in. So, I'm not going to get political and try and point blame on it. Are we, do we not collect enough taxes? Do we spend too much? I'm not going to go into that discussion. Okay. But there is a mismatch there of $2 trillion. Now, we don't have money. The way we make the bridge to that gap is by issuing debt, by borrowing the money. And you do that by issuing treasuries. So that has to be absorbed by the marketplace. Now, it does get absorbed. The question is at what rate? The more paper that's out there that you have to push, the higher the rate you have to offer to incent people to buy, right? So that's the game. Now, in addition to that, the purchase money mortgages that are being done out there, that also has to be absorbed.
Yeah.
And there's a third component that's very important. See, the Fed is offloading their balance sheet, quantitative tightening. They had their holdings reach 8.5 trillion, but since then, they've been reducing it. Currently, it's 7.1 trillion on their balance sheet. So that 95 billion a month, but call it $100 billion a month, that's hitting the marketplace. That's got to be absorbed, right? They're not selling, but it's just these things roll over and they've got to be absorbed. Or new mortgages that come to the market, they've got to be absorbed. So you add it all together, and that's $4.2 trillion. Now, in 2023, there was 4.5 trillion that had to be absorbed. And how did that get absorbed? Well, 8% mortgage rates, 5% 10-year treasury, 5.5% 2-year treasury. But there is an incredibly important element that could change all of that this year. Maybe. I think so. And here it is. See, the Fed's balance sheet, while it is being reduced, the Fed's not going to drop it to zero. Between 2014 and 2019, they were very comfortable with it being between 22 and 23% of GDP. So in order to get to that level, because they're dropping their balance sheet, but GDP is also growing, we might hit that by June or July, where the Fed might say, hey, you know what? We can start to taper our balance sheet. That would dramatically reduce the amount of supply coming to the market, which means less paper that you have to incent people to buy. I don't have to do it as high a rate because the demand will start to sop that up and there will be less of an interest rate offering. So I do think that rates improve. Now, there are things that can come out of the blue to hurt us. And here's one. And this is, I'll try and break this down. It's a little complicated, but it is critically important. And it's so little understood. And nobody talks about it because it's a complex and people don't really go there because they don't understand it. So, but let's do our best here to make it simple and easy. It's called the reverse repos that are out there. So what are these? I want you to think about it simply. So Chris, let's just say you and I and your wonderful listeners out there. So you're trying to make smart decisions. Let's say you're managing a bunch of money, like a bank would manage, and you're trying to make investments. And one of the things you want to invest in is debt, which means like you can invest in treasuries and things like that. But let's just say, let's rewind the clock to 2022, 2023. You know that we're in an environment where the Fed's going to keep pumping interest rates higher. So Chris, would it be a smart idea to buy a 10-year treasury at 4% or a 2-year treasury at 4.25% when you knew that the Fed was going to keep raising rates, that inflation was still an issue, and that there was a likelihood that rates would rise? Why would I lock myself into that? That's like buying a CD as a customer, you and I, knowing that, wait a minute, if I just wait some more, I'll get a higher rate, right?
Yep.
So what do I do with my money in the meanwhile? Now, as folks that are listening, you know what the smart alternative is, and you probably have done this, is you put it in a money market. Why do you put it in a money market? Because I can get a good rate of return, but each time the Fed hikes rates, my money market rate goes up. Fed, I get a better, right? So I keep up with it. That meant that people weren't buying treasuries. And that's what pushed treasuries. In order to get them to buy them, you have to go to 5% on a 10-year, 5.5% on a 2-year. That's what was happening, 6% on a 6-month treasury, because you had to compete with the lock-in for that period of time when the money market, so to speak, was going up. The equivalent of that money market for you and I is the reverse repos. So banks started putting money in reverse repos, $2.5 trillion worth. Now, when the Fed signaled that they were done hiking, banks said, this is a good time to lock in those high rates. So now let me get that 5% 10-year and lock in 5% for 10 years. Look, I could get 5.25 on the money market or 5.5 on the money, but that might change in 6 months. I might be looking at, 4.75, 4.5. A year from now, that might be 3%. So let me get that 5% yield and eat that up for 5 years, or 5.5 for 2 years. And that's what helped rates come down. But so this was like a piggy bank, and treasuries were being gobbled up. But in the meanwhile, that's gone from 2.5 trillion in that piggy bank. Believe it or not, we're between 600 and 700 billion right now.
Wow.
Perhaps you see where I'm going with this. Over the next few months, this will be drained and the piggy bank will be gone. Now, who's going to buy the treasuries? Who's going to buy the mortgage-backed securities? Without this piggy bank, you have to have new money come in. You'd have to incent perhaps with a higher rate, unless Janet Yellen, who's now peddling these treasuries, go visit Jerome Powell and say, Jerome, please, if you don't slow down quantitative tightening, what's going to happen is that we're going to have to sell these treasuries, but in order to get people to buy them, we're going to have to offer them higher rates, which means our debt goes up. We're in a worse position. We're making higher interest payments. Help us out here. Now, Jerome Powell is a Republican, but he doesn't care for Trump. Jerome Powell also doesn't have an allegiance to Biden because Biden didn't want to reappoint him. He wanted to appoint Lael Brainerd. So it's interesting how he's going to kind of, does he tell Janet Yellen, go screw yourself? Or does he say, maybe we'll help you out? But he holds the key. The Fed holds the key as to when they start to ease off on quantitative tightening. Now, I've done the math on this, Chris, and you were in my presentation in Orlando, and you saw I did the month-by-month estimates. To me, it seems that we get there June, July, to where the Fed might be 23, 24% of GDP, 22, maybe at that point in time, they say, okay, well, we could slow it down here. We'll still reduce our balance sheet, but not as rapidly. So I think that would be a good time. Now, there is a Fed meeting on June 12th. There's another Fed meeting July 31st. One of those two Fed meetings, to me, seems like a potentially good time for the Fed to say, we'll slow down quantitative tightening. And that's the key. That's the golden ticket for us. Now, it's always possible that something happens they don't. It's possible that they accelerate that if things like the job report gets worse, and I'll explain that in just a minute. But it could be a point in time where it might be April or May where the reverse repo money runs out. And now you've got the supply that's coming to the market without the benefit of that piggy bank. So even if the Fed's cutting rates on May 1st, which I think is highly likely, that the interest rate environment on mortgages don't yet respond until that quantitative tightening comes. And people are going to scratch their heads, say, the Fed's cutting, why aren't rates coming down? Well, that's because that quantitative tightening is still going out there, and we ran out of money in the piggy bank of the reverse repos. So that's why I'm watching that very carefully. Now, this is to say we could get this wrong. But as you could see, we really think this through in ways that most people don't. And now things can come out of the blue. But based upon what we're thinking, we think that interest rates should be lower this year. It's a very long way to answer the question, Chris, but I want to give you the logic and the rationale behind why we do this. I also mentioned the job numbers. The Fed is also asked, where do you think unemployment would be in 2024? Now, 12 of the 19 Fed members said that they think the unemployment rate would be between 3.8 and 4.1% in 2024. So that means watch 4.2%. Why? Because if we hit an unemployment rate of 4.2, you're going to have 12 of the 19 Fed members saying, holy shit, we got it wrong. We need to adjust. What does adjustment mean? Adjustment means being more aggressive with rate cuts and more aggressive with easing off on quantitative tightening. So that could be a magic lever for us, 4.2% unemployment rate.
That's incredible. And Barry, I think it's so valuable to really unpack where those numbers come from and why, because all of our listeners are loan officers, mortgage lenders, mortgage brokers, mortgage professionals. For them to be able to have this knowledge and then to be able to package it, put it out on social media, send it to their past customer database, it's that knowledge that you provide to the industry of the insights into why these things are happening that lead to those quality conversations with customers. So incredibly valuable, and thank you. Another component outside of, the larger dynamic of it is housing. We're still seeing in many markets a very tight supply in the housing market. How do you think that's going to affect prices this year? What do you think is going to happen to housing supply?
Well, look, I'm very proud of our calls on housing, and I think we really drilled down to, just like with rates, supply of paper coming on the market versus demand. And where so many people blew it on housing is they don't understand a few of the components. They don't understand the supply demand component. They go by medians, and they also don't understand affordability. So let's try and address those three areas. Okay, so affordability, let's start with that. That's kind of the easiest one. So in 2021, let's make something really simple, easy. $240,000 mortgage, 2.875% rate, gave you a payment of $1,000 a month. roughly. Give me a little leeway on a couple of dollars, right?
Deal.
So that's a P&I payment. So you probably, if that's your P&I, not PITI, P&I, your income's like $4,000 a month. That's the relationship. And this is where the media, math is hard. So the media blows it. They don't understand it. A lot of analysts, they don't understand the way it works. So your payment's $1,000 a month. Now, since then, rates have gone, let's pick a rate. I'm going to use rates that make it easy. Yep. That rate's gone to 6.875, but not only has the rate gone up, real estate values have gone up. So where you needed a 240 mortgage before, now you need, let's say, a 280 mortgage. And I'm just using these numbers to give you the conceptual, okay?
Yep.
That would mean your payment went from $1,000 up to $1,800 a month, an increase of $800 a month, or an 80% increase in payment. Who can argue? It is definitely less affordable. I agree.
Yep.
However, what offset in income do you need to offset that $800 a month payment? Do you need an 80% rise in income as well? No, you don't. You need a 20% rise in income for that $4,000 in a month income to make you that extra $800 to offset. Now, look, I get it. There's other factors that go up, I understand all that. I'm trying to make this simple just to understand the concept, okay?
Yep.
But meanwhile, at the same time, what people also forget is that your income's already gone up, according to ADP, close to 17% in that period of time, 16.5%. So that's the numbers from ADP. Through 2024, incomes will continue to rise. So what I'm saying is, if interest rates come down the way we think they are, and incomes continue to rise, you've very much mitigated a lot of the affordability concerns. Now, that's not to say people do pay more at the grocery store. I get all that. We don't have time to go through, an hour's worth of analysis here. I'm trying to give you just the basics. I am cognizant of the fact that this is an imperfect analysis. Mm-hmm. But on a conceptual basis, for the most part, there are ways that we are currently mitigating the affordability gap that will continue to mitigate it so that it is much closer than most people think it is. So that's one. The other is just, look, we just have too much demand and not enough supply. So if you want to say, look, rates are higher, and if we're looking at the fact that now prices are up, and if you look at the median income, it's not keeping up. Bullshit. Medians don't work, because you are counting a 16-year-old working at Wendy's. They are not a home buyer. Right. What you have to do is you have to subtract the bottom 25th percentile. If you subtract those who aren't home buyers today, God willing, they will be at some point. Let's wish them all wonderful and good things and great success in the future, but they're not in the game. Mm-hmm. So you shouldn't count that. When you go to a basketball game and you say, okay, how many points does each player have? You're not counting the guy who's in the concession stand. They're not in the game, okay? You should only count who's in the game. Those people in the game, when you look at their median income, it certainly does qualify and keep up. But the thing that you also have to remember is that with such little supply, even a reduced amount of qualified buyers overwhelms the amount of available supply, and that's why prices are pressured higher. So these are all things that, supply and demand, it comes down to, again, there's just too much demand and not enough supply, even with reduced affordability. Now think about what starts to happen when rates come down. According to the National Association of Realtors, 1% drop in rates, 5 million more people become eligible. Of course, not all of them are going to be buyers, but some will. And if you think inventory is tight now, what happens and what does that do to prices? Clearly, upside pricing pressure.
Yep, absolutely. 100%. Very well explained, Barry. I got it. So fantastic.
Well, you're very smart, but I think that people listening are very smart. And, don't think that this stuff is beyond anyone. No one comes out of the womb, gets a pat on the butt and starts quoting what the Fed's about to do. These are all learned behaviors. So, it is incumbent upon us. We owe it to our clients. We owe it to our family. We owe it to our success to become a master of our craft. We owe it to ourselves to make sure that we are the very best we can be, and to not be a salesperson, but be an advisor and a problem solver.
Yes, amen to that. And Barry, thank you for being so generous with your time. If I may, just one more question. Technology, also a major factor in the world, the economy, and housing. And I'm eyeballs deep in artificial intelligence right now, watching the news that's happening, and there's a lot of headlines about job displacement and what technology is going to be doing in the industry in the next year or two. And I'm just interested in your thoughts. What do you think about artificial intelligence and what's going to happen in the future?
Well, look, first of all, I love what you're doing with artificial intelligence because you're taking something that is very valuable and important, but you're really making it tangible. And the things that you're doing are critical, and the applications that you are using uh, with your knowledge and your expertise are making some big changes out there. But look, just like we talked about, we all have that ability, and or we all can find that. So I think that we need to be part of this. All of us do, because it's not some foreign object. It's something we've all been accustomed to. Just as you type on your phone, think about the amazing predictive text that happens. I mean, that's artificial intelligence at work. Something simple as that. It predicts what you're going to do, and that's kind of what artificial intelligence is trying to do here. Is it gives you what a prediction is. So we talk about the forecast that I'm making. That's theoretically real intelligence, not always getting it right. But artificial intelligence means it's not coming from a brain, but it is trying to make a prediction of an outcome, a prediction of a conversation, of how that will embody or look like a human being's response based upon all this data and these large language models that we have. So at its core, really, that's what's trying to happen. So that creates efficiencies,
Mhm.
that creates hopefully better experiences. I remember when voice recognition was supposed to be a wave of the future and it's supposed to create, but it was nothing but a freaking pain in the ass because it just got it wrong. However,
Yep.
today it's really sophisticated. I mean, you think about it, you go to your phone, you press the little mic button and you talk into it. It'll know where to put the periods. It'll know what to do. It'll actually do an auto correct and go back and correct it. It's amazing. If you watch it as you're speaking into it, it is fascinating, the artificial intelligence that is being used. So you're already accustomed to it. You already know it. You just embrace it and make it a part. Think about ways that you can make it a part of greater efficiencies, or talk to an expert like you and really get the ball rolling.
That's amazing, Barry. Thank you so much. Where do people go to find out more information about you? Where do you want people to go to take the next step?
Well, I'm easy to find. But if you'd like to connect with me on Instagram, it's I am Barry Habib. Look for the blue check mark. Unfortunately, there's people that try to copy and do fake accounts, but what are you going to do? So just look for the blue check mark, and you can reach me there. I put a lot of reels up there. I'm not as good at being consistent. I need to be better at that one. But there are a lot of reels out there that you can definitely share and use, and maybe bring some of the points that some which we talked about today to light with your clients, with your referral sources, or even just for yourself. But thanks, my brother.
That's awesome. Barry, thank you for being on the show. To everybody listening, thank you for listening, and we'll see you on the next episode.